Yes, over recent years, gold has been a better place, but that just changed. This is telling you that the money flow into gold, while it's been very strong over the last few years, was still within the range. And it's only in November that it finally broke out, in December even more so, and said, I'm out of here. The commodities sector, when you measure it versus the S&P also, is dirt cheap, but it's basing. Technically, we assess that as a topping process. We've had enough breakage in enough long-term metrics to suggest that's what it is.
Okay, ladies and gentlemen, so today we have Michael Oliver back on the show, and today we will look at the US economy, commodities, precious metals, and many other very interesting topics. So Michael, thank you so much for being here.
Good to be back.
It's a pleasure to have you back, sir. I apologize for my voice. I'm suffering through a very bad virus, but we'll get there. So Michael, if we could start by looking at the US economy first. So up until recently, there was this sort of consensus that we were seeing a slowdown. But then we got the recent GDP number recently, and then we got the initial jobless claims that looked better than expected. How are you viewing this?
Well, we don't pay attention to that stuff really. We look at the technicals, especially the momentum technicals of given markets. And what we see in the stock market, US stock market in particular, but also echoed in other markets, is topping process. And when we say process, we mean, it takes some time. And if you go back and examine closely the 2000 top, the dot-com top, or the 2007 real estate top, they were laborious. They didn't just make a high and collapse. It was like they made a high, then they dropped, and then made a new high. Oh, wow. And everybody get excited. And it was a teaser, but it was all part of basically a year-wide process of distribution, intermittent with rallies and even new highs, marginal new highs. So like we made a high early this year on the S&P just short of 6,200. Okay, and we backed off and then turned back up and made new highs. So far in the high 6,000s. Maybe we go up to above 7 before it's over. I don't know. But that we view as overall, technically, we assess that as a topping process. We've had enough breakage in enough long-term metrics to suggest that's what it is. And therefore, we don't trust so-called price strength here. And we measure other things within the market that indicate that. Now, the data points you mentioned, that's the kind of stuff the Fed likes to use as an excuse to do things, And so they got the one thing, the inflation thing, they're making arguments now that, well, maybe we got it down enough. Okay, right. Falsely defined inflation. Inflation is actually the increase in the money supply, the degradation in the money unit. That causes prices of everything to go up ultimately here, there, and everywhere. But when they get those unemployment numbers, like we've had recently, you noted, and other data points will come along too. But usually those data points don't get real dark until after the stock market has peaked in a way that even the average guy on the street knows it's peaked. Okay, so not at the peak, but maybe 6 months later, all of a sudden the dark numbers come in, and the Fed then pushes the pedal to the floor to try to save the assets they want to save, like government bond market or the stock market, et cetera. So that's what we see about the stock market. But in the monetary metals side, we see a totally different picture. And I know a lot of people make the mistake based on a few historical misexamples that, if the stock market goes down big, gold and silver go down too. It's totally untrue. Yes, there have been points in the past where you could find a hugely bad month in the stock market that's already been going down maybe for a year. And then suddenly gold and silver have a break as well. And people like, see, but really the major trends don't correlate well. So anyway, so I see a total opposite picture in the monetary metals starting just recently, in fact. And we can look at some charts on that if you want to.
Yes, definitely. And this topping pattern, Michael, how long could it potentially take in the stock market?
I bet it's near its end. We have some metrics, shorter term type stuff that may, usually when they inhale or exhale these more intermediate term metrics, they'll do it in a couple months. They'll get done what they want to do. And some of them hint to us that Yeah, maybe we're going to make another new high. You know, the S&P, for example, the last 3 months has crested all in the 6,900s price wise. Never could get up to 60 to 7,000. Nice big round number, you know. It wouldn't surprise us if they can stabilize now, and they've been actually been stable and boring for about 3 months now, uh, at the same price level. But if they go out and punch out that high, it wouldn't surprise us. Don't get bullish because of it, but it wouldn't surprise us that this topping process continues another couple months. In other words, where you don't actually go down hard, you actually maybe edge up some more. But the bigger metrics, annual momentum, quarterly momentum, things that are longer term yardsticks to measure trend by, they don't look good. They look like either one, they're already broken, or two, they're going to break because the numbers that break them are just right under your feet, quite literally, starting in now in the new year because the numbers have shifted up. Anyway, so that's what I see there. Yeah, it could hold in here for another couple months, maybe. We give it the benefit of that doubt. But after that, all the metrics line up such that the dominoes could start toppling, technical dominoes, in great coincidence, where long term and intermediate term all start to break. So that's
Mhm.
what we see. In meantime, the metals are roaring and commodities are starting to firm from very cheap historical levels. If you look at the Bloomberg, you know, was it 110 right now? Heck, in 2008, it was 237. So we're not even half the price we were, you know, in 2008, or in 2011, it was 170. So, you know, commodity prices, while people like to say, oh, commodity prices are hot, they're really cheap compared to their historical levels. So that's another area to watch for upturn. Lag too, but following gold.
Right. Just before we move to precious metals, Michael, you know, if you look at the stock market over the long term, would you expect the equities to just, because of the structure of the monetary system, the fact that the Fed always tries to save the markets over the long term, do you think the markets will just continue to go up, let's say in the next
No, no.
two, no?
The only way I think they continue to go up, and I don't think we're at that level, is literally to go Weimar Republic or Venezuela style. You know, you look at the Venezuelan stock market. In fact, we put out a chart of it a couple months ago, and it's the most beautiful exploding stock market you could see, measured in their own currency. And of course, their currency is devaluing, quantifyingly increasing in supply by huge metrics, and therefore you could measure the price of bread and it would be vertical in Venezuela, or the price of cow manure. You know, anything's exploding down there because the currency is collapsing. So yes, if the central banks of Japan, US, Europe, etc., decided to print and go crazy, then heck, maybe everything goes up. And then you have to realize, well, it doesn't really matter anyway, because what it's doing is just reflecting the burning of fiat money. Okay. So now I tend to think, no, the stock markets, Europe, Japan, us in particular, are topping together. And we're the biggest bubble out there, really. This time around, Europe isn't the same quantified bubble that we are. You know, measuring, for example, go back to the 2009 bear low and see how much Euro 600's up, or look how much many indexes that have gone up at that time are up compared to the US. S&P's up tenfold. NASDAQ 100's up 20-fold in that 16-year period. And so it's the oldest and the most overpriced bubble in US stock market history. And when it breaks, it could be horrendous because of the implicit built-in errors that are inside that bubble in terms of pricing, corporate spending based on certain assumptions that money's cheap. Two, stock market looks good. You know, all kinds of false assumptions. And also investors, you know, the average guy out there, you know, when he looks across the horizon, doesn't see anything really good in his life. I'm talking a middle class guy. You know, maybe his wife just got laid off. Their credit card's maxed out. They're delinquent on their credit card. They have to ask for delays in paying their taxes, et cetera, et cetera. The one good thing out there for him is he can look and say, oh, my portfolio last year went up a bit, 10, 15% if I match the S&P. If that ever went by the way, real quick, all of a sudden you gave that the whole year, let's say the 2026 gains, I think it's like 15% in the S&P. If that got wiped out and suddenly puts you back where you were in 2024, you feel kind of dark because there's nothing to smile about. And I suspect that's coming. In which case, what? Fear, anxiety, panic, and the calmness we feel right now won't be there anymore, and the numbers will get dark. So that's what I think is right around the corner, and I think the beneficiaries are going to be the monetary metals.
Okay, so let's talk about these monetary metals, Michael. So gold, even since the last time we spoke, keeps performing really, really well. It had that recent top pullback. Now it's sort of
Yeah,
in
yeah.
that high area. How are you viewing gold in the current environment? And the question I like to ask recently, Michael, what is the difference between what's happened right now and what happened in 2011?
Well, if you could scroll into that report I sent you, there you go. Now that top chart shows gold price since 50 years ago, okay, since it was legalized in the US. And it's priced, it's a price chart only, not momentum, but it's scaled on a ratio basis, a logarithmic scale. So that a move, for instance, the 76 low in gold was just above 100, and by 1980, it reached 850. Okay, that's an eightfold move in price, eightfold gain from bear low to bull high. And lo and behold, if you go back to 2001, gold made a low at about 260. And by 2011, a different span of time, 10-year move, it was an eightfold move. Same dimension as the first one on a ratio scale. And then we've started our bull market from the bear low in 2015, which for gold was $1,050 in US dollars. And right now we're only fourfold gain. So when you stand back and look at this and say, well, inhale, exhale, we're only halfway inhaled here compared to the two prior bull markets on a dimension move. So, if gold even went well above 8,000 to get to another eightfold move, it would only be matching the same dimensions it's done twice before in the last 50 years. The difference this time in our assessment is the technicals and fundamentals are far different, far more bullish for gold and for monetary metals than they ever were. Hence, going back to 8,000 would be just a yawn. Oh, we've done it twice before. Big deal. Don't even expect 8,000 to stop it. But we're just pointing that out because people think, gosh, if you look at an arithmetic chart of gold, normal everyday chart, you think, oh my gosh, it's left the page. No, it hasn't. It's only half the dimension of the prior two bull markets. And that's what brings us highly focused now to the chart below that on the same page. Silver. 50 years of silver. Unlike gold, which the 1980 surge was a tenfold move from the bottom of that range to the top, much of it compressed in the last 2 quarters of that bull move. Then it came all the way back down to the bottom of range and duplicated the same thing again in 2011, but it wasn't a new high. Gold was making a much higher high than it made in 1980 when it got to its high in 2011. And yet silver, while it had a big move from the bottom of that 50-year range to the top, it was just duplicating the same price that it was in 1980, 30 years later. So, how come? It moves with gold. It goes up and down with gold. No issue about that. But why couldn't it go up above the high of 1980 like the same dimensions the gold did? Okay, now we've broken out finally. Okay. And on this log scale chart, if you did what gold has done twice before, now maybe is doing a third time, if you took the prior move in silver on a ratio scale and added it to the point of, we could be $500. Just the dimension of the range. So if you look at a chart in an old orthodox way, a range, top to bottom, what's the dimension? You add that to the breakout level, and that's your swing objective. Well, in this case, you're talking a 10-fold move from the bottom of the range to the top. Well, a 10-fold move getting above 50 means you could go to 500 just to match the dimension of the ratio moves that have persisted for 50 years. And why has silver been confined for 50 years while most other markets have not? Copper hasn't, lead hasn't, gold certainly hasn't. I think silver's headed now for a new reality. And old notions of what's expensive or what's overbought, throw them out the window. And I think a lot of this move that other arrow I've got plotted there could occur in a matter of a couple quarters. Not that ultimately go to 500, let's say, in a couple quarters, but to easily go to a couple $100. And that's our bet. I bet that sometime by the second quarter, we'll do that. And how do we time that? If you go back a couple pages, I'll show you where we set the clock. Spread charts tell you that. Keep going. More. Okay, now let's go to the top of that page there. No, go one more page even beyond this. It makes another major point. One more page there. This page shows charts that measure the monetary metals, gold, silver versus the stock market, gold versus the stock market, and even the gold and silver miners. But the top chart here shows, going back to 2013, each month we take the close of gold and divide it into the S&P price and express it as a percent, and we plot it. Okay, so these are monthly closes going back, to 2013. It's when gold was really collapsing back then. Also in relative performance, it was coming down. But since about 2015, you see the price action, the spread action has basically been either side of 50%, been above it and below it, above it and below it, but sort of really going sort of sideways. So gold's been hanging in there versus the S&P, been doing as well. November's close broke out above that 4-point, very gradual downtrend line that capped off this relative performance chart for 11 years. It broke it out in November. Well, of course, in December, gold had a good up month, while the S&P had a slight down month, I think. The spread went even further in December. But that chart has just now broken through a huge wide base. This is the start of something, not the end of a bull market. This is telling you that the money flow into gold, while it's been very strong over the last few years, was still within the range. And it's only in November that it finally broke out, in December even more so, and said, I'm out of here. What it's telling you is money is starting to shift from the stock market to the gold market. It's actually been going on since 2024 when you were near the bottom of that range, but now it's broken out. So this is effectively a fresh buy signal telling you if you're an investor, should you be in gold or the stock market? It says, yeah, you should be in gold. It's just begun. Okay, scroll down to that next chart right below there, silver versus S&P. Also in November, it broke out over a similar basing pattern and relative performance to the stock market. That arrow shows where it was in November. Look at the December close, whoosh, even further. So silver has also said, I'm out of here, freshly so, versus the US stock market. This is not a late signal. This is an early signal. And then scroll down one more, surprise most people here. This is the gold and silver miners via the XAU index, which includes gold and silver miners. It's done the same thing. It broke out in November, gained more in December of a base of performance that's defined by 1, 2, 3, 4 peaks hit that red line before you broke out. So each of these charts are telling us that the monetary metals and their miners have only just shifted trend versus the US stock market. It's a fresh buy signal telling you if you're going to reallocate now, you're not late in terms of the asset class shift. So these signals should not be occurring if, in fact, as the skeptics think, we're at a top in the monetary metals. This should not be occurring. These guys should have broken out years ago and been at some peak a couple years later. Then maybe we could talk about a top. This just began. So This is a smack in the face indicator that tells you, no, don't believe in the skeptics. Anyway, these are important. Go to the next page again, and we'll look at that other chart, which shows, okay, let's say you're in the monetary metals, whether you own bullion or mining stocks or ETFs on silver or gold, whatever. Where do you emphasize your long position within the monetary metals? Yes, over recent years, gold has been a better place, but that just changed. So not only did silver and gold break out versus the S&P, but silver has broken out of a decade-wide basing range versus gold. It's saying, I'm coming out of here. I'm going to beat you, gold. Now, the reason this is important is not just that the shift has occurred freshly, but that whenever this shift occurs, like this chart you're looking at here, a similar event happened back in summer of 1979. In the next 5 months, almost 2 quarters, silver quadrupled in price, not just beating gold, but quadrupled in net price in 5 months up to the 1980 January high. A similar pattern occurred in September of 2010. Silver had already been in a bull trend, so had gold. But at that point, silver suddenly broke out versus gold. And in the next 7 months, so about 2 quarters, it doubled and a half in price. Okay, this just broke out. So we set our clocks here and say, listen, we've learned in the past, and there's other examples of this, where when you do this kind of breakout, give it a couple quarters and you should see a gush in net price. Now, maybe it goes further, but the gush part, the extreme change, occurs literally in the next couple quarters after the spread breaks out. The spread just broke out. Don't expect a top or any sort of topping action or even a corrective action of significance until we get into the second quarter. And this spread isn't going to be where it is. Now, scroll down, you'll see some examples of where silver has been. Right now, it's at 1.6% of the ounce of gold. What we do here is we divide silver ounce into an ounce of gold, express it as a percent. This shows 50 years. What was the peak spread reading on a percentage basis of silver price versus gold going back to 1975? Well, you get that red horizontal line is at 2%. And you can see that in 20 years, in the past 50 years, silver's at least been 2% or higher. Well, right now it's 1.6. And we just broke out over the last 10 years of highs, that little green line, which we showed closer up on the chart above. You just broke out. If you even just go to 2%, I mean, that's a huge move from 1.6 to 2 on a ratio basis of silver versus gold. But we're in a bull market. And when you go back and look at the bull markets in net price of silver and where the spread was then, look at that 79 peak when it was gushing to the upside to the early 1980 high in price. The spread was at 6.5%. And then go to the 2011 high when, again, silver rushed up to 50 within the old price range. The spread was over 3%. Well, right now at 1.6, just to get to the spread level that we saw in 2011, you got to like double silver's performance level that it currently exists at. And since we're in a bull market, I would tend to think that one, that 2% level is not going to be resistance. Instead, it's going to go up and challenge, perhaps even take out the performance highs it saw at the 2 prior bull markets, the one at over 3% and the one over 6%. Don't be shocked. But that just shows how cheap silver still is, despite the recent breakout on that chart above. We took out 10 years worth of highs. You're still cheap. And I think silver's new reality in price is also going to be reflected by a new reality in its relative performance. So again, we have fresh signals here that say, hey, it's only begun. Quit talking about a top.
Wow, these charts are fascinating, especially this last one. I think it's a great illustration that because it pretty much indicated every single top, right? with
Yeah,
the
you're not anywhere near a high of any kind, and it just broke out, so if this were a price chart and I just broke out over that ceiling with the green line there or shown on the chart above, yeah, it's a fresh breakout. Yeah, it looks like you've been chasing silver because silver's up there, but silver only just also broke out above its old stupid price highs. $50, $50. So it's not really, even if you took an arithmetic price chart of silver and you measured from lows that were $4 and $5 during the last 50 years and highs that were both at 50, you've got, like a $50 range there almost. Well, add 50 to 50, the breakout point, you got 100. So even on an arithmetic scale, silver should just go to 100 just to match the simple arithmetic scale. But I'm arguing on the log scale, it's likely to do that. And also reprice itself fairly versus its real dollar value. Remember, you look at an M2 chart and look at the massive increase in the money supply since 1980 or even since 2011. And if you try to match silver to simply match the decay in the real buying power of the US dollar, silver be in the hundreds. Okay. So you need to keep that in mind if you're considering participating or you're already in the monetary metals.
very, very good points, Michael. So would you play this by buying physical or buying the miners? Because in this inflationary world, of course, in theory, the miners should perform better, but then we have the inflation side that could put a cap
Well,
on
no,
it.
there's a time the miners, gold miners versus gold, I don't have the chart here, are very near a massive 11-year wide base, relative performance base versus gold. XAU index divided into an ounce of gold collapsed in 2008 through 2015. And that spread got all the way down to 4%, where the price of XAU was only 4% the price of gold. Heck, if you go back to the 1980s, 1990s, up through about 2008, if you divided XAU index into the price of gold, it was like on average 20, 25% of the price of gold. Right now, we're about 8%. So we're still dirt cheap, gold miners versus gold. That spread could break out, in which case, and I think it's going to, that will be a statement that if you're in the monetary metals, again, shift to silver, but also shift to the miners relative to gold. And I think within the miners, it's also time to focus more on the silver miners versus the gold miners because they're vastly undervalued to silver. Silver miners are, and the silver miners are vastly undervalued to the gold miners. So when this catch up occurs, this repricing, this new reality, that's the category within monetary metals that is the most depressed, hence the most likely to resurrect in a violent way, silver miners. So yeah, good question. I think that's focus within the monetary, look at silver on the metal side, and on the mining side, it would focus more on the silver miners.
Right. And Michael, if we look at pretty much all other commodities measured in gold, they look unbelievably cheap, and gold looks very,
Yes.
very expensive.
Yeah.
So, and you're still bullish on gold and silver, but
Mhm.
maybe will it be wise to maybe convert some of that into these very cheap metals as well?
Right now, I'm entirely focused on monetary metals, but you're correct. We measure the Bloomberg Commodity Index, which is a well-weighted, balanced index of commodity prices. And there's some sectors in there that are strong right now and some that are still very anemic, like the oil sector is anemic, very weak. But I think oil is about to snap back to the upside, by the way. Technically speaking, I can see the argument. It's very close to upside breakout levels. Don't see it on price, but on our momentum, we do. So even that weak component looks ripe for a fairly violent upturn. But overall, the Bloomberg Commodity Index is still one dirt cheap historically. It's like now at 110. Like I said, 2008, it was 237. Okay. So we're not even half the price we were then, whereas gold's above that price, right? Okay. The commodity sector, when you measure it versus the S&P also, is dirt cheap, but it's basing, meaning It got dirt cheap a couple years ago and hasn't gotten cheaper. And we're just starting to flatten out. So it's not loss value versus the S&P. It's still just very depressed. The technicals look like that category as an investment category to look at is primed for a bull trend. I don't think it will beat gold on a percentage basis, but I do think it will be a good place to be for an investor to be looking at commodity related stocks like oil sector stocks, agricultural related stocks like fertilizer companies, base metal miners, things like that. They will reflect the upturn in the Bloomberg Commodity Index. And by the way, those sectors of the stock market, if you're afraid that one, the stock market's going to enter a bear market, therefore, why should I buy anything in the stock market? Those sectors don't move in sync with the stock market. There's plenty of times when the stock market's been strong and they're anemic. So they do the opposite sometimes. So I would look at that as a probably something when it's already, I think it's already begun, by the way, this shift. But I think it's likely to last several years. So it's an investment grade. It's not a trade. It's an investment grade point of participation, I think, to just in an unleveraged way own base commodity related stock companies, or their ETFs that house some of these companies. I think it's a good place to be. So I think you're right. Yes, that is another place to be looking.
Mhm. So we have precious metals, commodities. Would there be any other sectors that you're interested in, Michael?
No, monetary metals and commodities. I think the world is about to shift out of the bubble and the enthusiasm that's wrapped all around that bubble. And by the way, it hasn't always been AI. AI has been the leader for the last couple of years of that now 16-year-old bubble market, stock market. Just like in the dot-com era, in the latter years, the internet stocks were the leader. And when the market turned, they weakened first in a subtle way. While the S&P stayed firm, the NASDAQ 100 started to ooze a bit. Nobody noticed this. And it wasn't until the spread relationship between the leader, NASDAQ 100 back then, 2000, representing .com, and the S&P started to break down where that relationship started to weaken. Not so much the price chart breakage in NASDAQ, but just the spread between it and S&P. That's when the market started to cave. It's been late 2000. We're starting to see some of that now, where over the last couple of months, NASDAQ has been anemic compared to the S&P. And I know a lot of investors out there have said, oh, this is good rotation. The market's finding new leaders. The game doesn't work that way. When you rotate out of the leader in the latter phases, that's a bad sign. And yes, there will be things that do better than AI. And like, look at NVIDIA now compared to its high, compared to S&P compared to its high, or financial sectors closer to its high than NVIDIA is. Those are going to break. But as far as other places to be, I think the world's going to shift their attention and then their emotions more from the paper assets that they've been bubbled all about for the last couple of years, especially into things under their feet. In a way to put it crudely, grains on the dirt, metal under the ground, oil under the things that are real they can touch, and leave behind the things that are breaking. And I think it's going to be not only an investment shift, but I think there's going to be emotion attached to it as well, where people suddenly want to have something that, a bar of silver, makes you feel pretty good, especially if it, has doubled over the last 6 months or so, you get my point. I think those are the places I'd be, monetary metals, but also, though not the same bang for the buck, but basic commodities and stocks.
Right. Michael, we covered a lot. These are pretty much all the questions I had. And would there be anything else that maybe you would like to mention that we haven't covered yet?
No, there's a couple markets to watch that are ambush triggers. Everybody's focused on the stock market and internals, like what's NVIDIA doing? What's this stock doing? They need to be watching closely the T-bond market, long in 30-year T-bond futures, for example, the long end of the government debt market, which is very sick. Okay. It crashed in price, rose in yields. From 2020 to 2022 low, the T-bond futures dropped from 190 down to 117, much of that occurring in in 2022. You could draw a line sideways on T-bonds, whether it's a yield chart at a high level or price at a low level, and it's gone dead sideways. It's tried to base and come up out of here, but it can't seem to do it. And we measure that it's tried 3 separate times, and usually 3 times is all you get. And if the third time doesn't work, watch out. Right now, T-bonds are trading around 115 futures, T-bond futures. You drop down around 111, and we'll specify the numbers clearly to our subscribers because they do shift. And you could expect that market to start to puke again, meaning yields break out to a new high. This end of the market is not controlled by the Fed very well. They control that short end, but they don't control the long end. And Williams, who's the president of New York Fed, a month ago, or a little longer than that, made a speech and said the Fed is now going to quote, buy bonds. And he said the reason for that was not that they needed to support the government bond market, that would be a panic statement, but because of, quote, illiquidity in that market. Oh, great. Okay, no problem, right? Well, they've been buying for the last couple of months, and if you look at T-bonds, they're not going up at all. All they're keeping is it from collapsing. If that market gets out of control on the downside, even if just it's a couple month panic, that's going to totally upset the stock market because it's a factor that they've gone to sleep on. Why? Because that market's gone to sleep. If suddenly you get the long end rates piercing to a new high or the bond futures drop into it down anywhere near the recent lows, that's going to be a panic. The other one's the dollar. The dollar has broken all of our long-term momentum trends. The only thing that's hanging on there is there's a trend line on the price chart. You could go back to 2008 and any idiot could draw it. And you're hanging in clustered, anemic on that line. But momentum is already broken. It's massive trend lines that go back to 2008 as well. Momentum is usually right and it usually leads price. That market, while it's been quiet for about 6 months, I'm talking dollar index, which is really the euro upside down and the yen combined. It constitutes 70% of the dollar index. And, they're pieces of fiat as well. So you're measuring crap versus crap, pardon me. But if that market starts to accelerate on the downside, the dollar decline, and the T-bonds start to break their supports, those are headlines the public doesn't want to hear or see because these markets are huge. They dwarf the stock market, especially the T-bond market. So that's something I'd be watching as a factor that not only damages the stock market, but panics the central banks, not just ours, into full print mode. Meaning what? Gold and silver benefit.
Well, Michael, great points. I have really enjoyed our conversation, and thank you so much for your time.
Thank you, Vlad.